For nearly 80 years, a single currency has defined how the world does business, but few people know how the dollar rose to power, or why that power is now beginning to fade. In July 1944, while Europe was still burning, 44 nations met in a small town in New Hampshire called Bretton Woods. Their goal was to rebuild the global economy, and to make sure the chaos of the 30s never returned. The United States emerged from the war untouched and dominant. It held about 2/3 of the world's gold reserves, its factories were running at full capacity, and its currency was trusted everywhere. So the delegates agreed. The US dollar would become the world's anchor, backed by gold at $35 per ounce. Other currencies would link their value to the dollar, and the dollar would link to gold. It was elegant, simple, and for a generation, it worked. But behind the stability was a quiet imbalance. The US could print the world's reserve currency, while everyone else had to earn it through trade. In economic terms, America controlled the world's monetary oxygen. By the late 1960s, the system began to crack. The Vietnam War drained US gold reserves, inflation rose, and nations like France started demanding real metal instead of paper promises. President Charles de Gaulle even sent warships to New York to bring gold back to Paris. On August 15, 1971, President Richard Nixon made a historic announcement. The dollar would no longer be convertible into gold. Overnight, money became backed not by gold, but by faith. From that moment, the global economy ran on trust. Trust that the US would protect the value of its currency and the stability of its system. The dollar was no longer a symbol of gold, it became a symbol of confidence. And confidence, as history shows, can be lost. Chapter 1. The Architecture of Power. The dollar isn't tied to gold anymore. Yet somehow its power didn't vanish, it expanded. Because the US replaced gold with something even stronger: control of the financial system itself. But how did the US dollar hold its value? The first pillar is infrastructure. A major part of international payments passes through US-linked systems: SWIFT, Fedwire, and CHIPS. According to SWIFT's 2024 review, nearly 50% of global transactions are still conducted in US dollars. That means the US can see, and if necessary block, a major part of payments on Earth. The second pillar is debt. US Treasury bonds are treated as the world's safest asset, the financial equivalent of oxygen. Foreign governments, banks, and pension funds hold over $7 trillion in treasuries. That demand keeps US interest rates low and allows Washington to run deficits others could never afford. The third pillar is institutions. The International Monetary Fund and the World Bank, both born from Bretton Woods, issue loans in dollars, binding entire nations to the US financial orbit. When a country borrows, it doesn't just owe money. It owes allegiance to the system that prints it. And behind all of it stands military and political power. The US Navy secures global shipping lanes, the Federal Reserve anchors liquidity in every crisis, and US sanctions enforce the rules. Money, might, and policy all linked through the same currency. The result is a self-reinforcing cycle. The world uses dollars because it's safe, and it's safe because the world uses dollars. It's not just a currency anymore. It's a global operating system, one that quietly decides who gets credit, who trades oil, and who can be cut off with a single command. But every empire built on networks eventually faces resistance, and that resistance has already begun. Chapter 2. When confidence broke. Every empire starts to decline the same way, not with defeat but with doubt. And for the dollar, that doubt began in 2008. When the US housing bubble burst, the entire world economy froze. In a matter of weeks, trillions in global trade and savings vanished, and suddenly the safe system looked fragile. Around the world, central banks scrambled for dollars, not because they trusted America, but because the global system had no fallback. The Federal Reserve printed nearly $4 trillion to rescue banks worldwide. The message was clear. The global economy didn't just rely on the United States. It ran on it. But the real fracture came later, when the dollar stopped being just a currency and became a weapon. In 2014, after Russia's annexation of Crimea, Western nations cut key Russian banks off from SWIFT. For the first time, entire countries were digitally exiled from the global economy. Then came Iran 2018, Venezuela 2019, and again Russia 2022. Every sanction reinforced the same lesson: whoever controls the dollar controls access to the world. Nations took note. China accelerated its cross-border interbank payment system. Russia built SPFS, its own domestic alternative. And the BRICS bloc began discussing a new settlement currency. Between 2000 and 2024, the dollar's share of global reserves quietly fell from 72% to 58%. It's still dominant, but the direction is unmistakable. The cracks are small, but they're spreading. What began as isolated resistance is now a coordinated movement, a slow, deliberate effort to build a world where the dollar is optional. And at the center of that resistance stands a nation quietly stockpiling something far older than paper promises: gold. Chapter 3: China's Gold Strategy. For decades, China's strength was counted in dollars. Its vast reserves of U.S. treasuries tied Beijing's fortune to Washington's debt, a relationship built on mutual need and quiet imbalance. America controlled the system. China supplied the fuel. That arrangement worked until it became dangerous. When the West froze Russia's reserves in 2022, Beijing saw what it had long feared: that in the dollar order, ownership exists only by permission. It wasn't the loss of money that mattered. It was the loss of certainty. If it could happen to Moscow, it could happen to anyone. China's response wasn't panic, it was planning. For years, it had already been reducing its U.S. bond exposure, slowly trading paper promises for tangible leverage. But after 2022, the purpose changed. Selling treasuries was no longer financial housekeeping. It became part of a wider design, a strategy to build a reserve base immune to foreign control. That design has two pillars. The first is diversification, a gradual retreat from U.S. debt, down from $1.3 trillion in 2013 to less than $760 billion today. The second is conversion, channeling those resources into real assets, most visibly gold. Gold sits at the center of the plan because it solves three problems at once. It strengthens China's balance sheet without inviting outside interference. It gives credibility to the yuan as a settlement currency. And it positions Beijing for a world where trust must once again be backed by something real. Since 2022, China's official reserves have climbed past 2,200 tons, while estimates of its true holdings run far higher. The pattern is deliberate. Steady, monthly purchases that signal endurance, not speculation. Inside China, the same behavior repeats. At the Shanghai Futures Exchange, physical inventories have surged from near zero in 2023 to over 80 tons in 2025. Evidence that households, corporations, and state institutions are all adjusting to a new idea of security. This is what makes it a plan rather than a reaction. China isn't hoarding metal for nostalgia's sake. It's engineering a monetary firewall. In a crisis, gold can stabilize its currency, support trade within the BRICS bloc, and give the yuan a credibility no fiat system can offer on its own. The long-term objective is not a formal gold standard, but a gold-anchored sphere of influence. A network of nations trading through China, settling in yuan, and trusting that behind that currency stands something of substance. That network may soon take on a physical form. Reports suggest that Beijing and its BRICS partners are exploring a so-called gold corridor, a decentralized vault system stretching across member states, where gold reserves would be distributed, mutually verified, and linked through shared settlement infrastructure. If realized, it would create the first transnational reserve network not built on credit but on collateral, a foundation of trust that exists beyond any single government's reach. Whether it remains an experiment or evolves into the backbone of a new monetary order, the intent is unmistakable: to make gold the connective tissue of an alternative financial world. The BRICS alliance is the scaffolding of this new order. Russia and India already settle part of their trade in local money. Saudi Arabia and Brazil have joined bilateral yuan deals. Together, these countries control the majority of global commodity output, and they are quietly testing what a post-dollar marketplace might look like. Meanwhile, the rest of the world is adapting. Central banks from Asia to the Middle East have been net buyers of gold for over a decade, but since 2022 those purchases have accelerated to levels unseen since the 1960s. Today, the total value of official gold holdings stands almost equal to U.S. treasuries, a balance that would have seemed impossible only a generation ago. It is not yet a replacement, but it is already an alternative. For the United States, the implications are profound. The dollar remains dominant, but dominance built on trust is fragile once alternatives exist. Each ton of gold China locks away, each trade BRICS settles without the dollar, reduces America's monopoly on confidence. The dollar's decline won't come from collapse, but from competition, from a world that suddenly has options. China's golden plan, then, is not about destroying the old order. It's about designing the next one: a reserve system grounded in assets, a currency backed by credibility, and a financial architecture resilient to political power. In a century defined by digital money and vanishing trust, China is betting on the one form of value that cannot be printed, hacked, or sanctioned. It isn't just collecting gold, it's rebuilding the foundation of belief itself. Chapter 4: A World Beyond the Dollar. Every empire believes its currency will outlive its decline. But when the world begins to move past the dollar, it's not just prestige that fades, it's power. For the United States, the costs of losing monetary dominance come quietly, then all at once. First, through debt. The demand for U.S. treasuries, once infinite, begins to thin. Foreign central banks, led by China, are diversifying away, trading dollars for gold and local assets. That shift forces Washington to pay higher yields to keep buyers interested. The U.S. debt machine still runs, but each turn of the wheel is heavier. More interest, more deficit, more printing, and less trust. Then comes inflation. As global trade moves toward alternative currencies, the dollar's reach shrinks, yet its supply remains vast. The same number of dollars now chase fewer international transactions. Imports rise in price, and the inflation the Fed once exported abroad starts coming home. The U.S. consumer, the backbone of global demand, suddenly pays for the privilege of American dominance. And with inflation comes instability. Rising rates strain corporate credit and household debt. Stock markets wobble under the weight of higher capital costs. The financial strength that once defined America begins to look fragile, not from lack of money, but from loss of faith. Beyond finance, influence erodes. For decades, sanctions and dollar access gave Washington quiet control over its rivals and allies alike. As countries build alternative payment rails, from brick settlement systems to gold-backed corridors, that control slips. A world where the dollar is optional is a world where U.S. policy can be ignored. Even the military edge begins to dull. Without dollar primacy, borrowing for global projection becomes harder. Defense budgets swell just to stand still. And every crisis now costs more, not just in politics, but in interest. This is the paradox of empire. Power built on credit eventually pays its own interest. The decline won't come through collapse, but through constraints, through a slow tightening of the financial room in which America once moved freely. The dollar will not vanish. It will still matter, but it will no longer command. And for a nation built on its currency, that might be the deepest loss of all.